Thanks, everybody. We're going to talk to you about IPOs, and we got a great panel to do that. To my left, to your right, is Gene Munster, Managing Partner at Loup Ventures, Nicole Quinn, Partner at Lightspeed Ventures, and Jack Cassel, Vice President of Listings and Capital Markets at Nasdaq. So here we are, exactly 8 months into the year of the IPO. Already we can safely say this will be the biggest year for offerings in at least a decade. In this panel, we're going to dig into what lessons we can take from what we've seen so far and what to expect for the future. First thing I want to talk about is we know there have been a lot of IPOs and some noteworthy ones, but what should investors take away from how the stocks have performed? Uber and Lyft have been not great. There have been a number of companies that have been blowing up, Zoom and Pinterest and Beyond Meat, which we were just talking about on the previous panel. So what's the takeaway so far, Gene?
I think that there's this balance between the near-term opportunity versus the long-term. I think of Uber and Lyft. They have a fundamental pole position to change how humans move and we move things around, change mobility. But the difficult part there is, I think one of the takeaways is that the investment period, we're still in the throes of that investment phase. And so as investors debate about how long we are in that phase, that has a negative impact on how those stocks perform.
They're spending tremendous amounts of money, billions of dollars.
Right, and I think the simple takeaway is this: where are these companies at in their investment versus growth phase? And I think that in the case the two, Uber and Lyft specifically, that one is most pointed, the fact that they're still in that. If you look at the ones that are working, they're still investing, obviously, but we're starting to see the benefits of growth. And separately, there's a competitive piece to it too, where Lyft and Uber are just going head-to-head, where some of these other ones don't have that direct competition.
Does the market reaction maybe suggest that the public stock investors don't have the appetite for that sort of like high spending, high losses growth phase?
I think it's pretty interesting because if we were asked this question even just a few months ago, the answer would be so different. Blue Apron was such a disaster that it caused an overhang for the whole space. We were early investors in Stitch Fix, which is a really strong business, has great growth, but also capital efficient. And there was just so many public investors who were saying they didn't want to invest in another e-commerce company because of the way that Blue Apron had gone. I totally agree with Gene on Uber and Lyft. But now there's been some really terrific outcomes. So I think people are looking at Beyond Meat up 700%, up Zoom up 200%, Chewy, Pinterest both up 50%. Then I think you have Fiverr and The RealReal up another 25%. In fact, one of the only ones that's down is Slack, and that wasn't even an IPO. That was a direct listing. So I think we're really in a great environment right now. To these earlier points, I would say the most interesting thing for me is that public investors think so differently to private investors. Private investors quite often will just focus on growth at any cost. And that's really now catching up to them because the public investors want to see profitability or at least a line of sight to profitability in the next 12 to 18 months. And so within that, one public investor actually said to me, the sad thing is that there's 3 stages to get to IPO. The first is winning your customer, the next is a strong business model, and then the last is the sprint to profit, the sprint to liquidity. And people are missing out on that second one. This is people's issue with Uber and Lyft to the earlier point. And so I think that's why we're seeing businesses like Chewy and Zoom do so well, because they have strong business models.
Jack, the next mega IPO is likely to be WeWork as soon as September. I would imagine Nasdaq will be trying to vie for that business to get the exchange listing. But what does the activity we've seen so far tell us about the future? WeWork loses a lot of money. They spend a lot of money. Should shareholders be concerned about how the market reacted to Uber and Lyft?
No, I can't necessarily speak to any particular names, especially they may be on file confidentially, but until something's flipped public. But I think broadly speaking, just to echo what we've seen in the markets, there is a large investor appetite for this growth. And I think broadly speaking, we've seen the companies that we've brought to market, and especially this class for the first half of the year, or even the last 18 months, there's an evolution of their go-to-market strategy from the IPO process. And they are meeting with a lot of these investors earlier in their private, while they're still private, kind of 18 months, 24 months ahead, testing their narrative, testing their metrics, testing their KPIs to see what's resonating with that buy side. And so as they then come to market, there's a confidence level and there's a familiarity with these companies that has the buy side show up and continue to follow on their investments. And so to the point of the second half of this year, I believe this continues. We've got a great class of companies that we've been in discussion with and will likely come to market in September, October timeframe. Typically you'll see...
You want to tell us who those companies are?
No comment. Thank you. But it's a lot of people that you cover. It's a lot of people that we know and work with and/or is part of our daily life. And so a lot of exciting stories that are coming to market. And I think this is going to continue through at least into mid next year. Typically, you'll see some form of a slowdown around presidential election. I think this year in particular, there's going to be at least a slowdown as the capital markets world figures out kind of the positioning and the risk associated with each respective nomination or candidate, I should say. But again, we're very confident and bullish that this continues for at least the next 12, 18 months.
Are you as confident and bullish that is this the year of the IPOs going to be the new reality, or is this year an anomaly?
Love the near-term pipeline. Thrilled to hear that. We've had 6 $10 billion plus IPOs this year. There's, by my count, love to hear your count, 4 more coming. That gets us to 10. If we look at the lineup coming into next year, we probably have 2. That the way I am looking at this, maybe 2. So, I mean, it's pretty simple. This is just, we had a lot of pent-up demand this year. So my view is, unfortunately, we're working through it this year, and next year will be I think a marked, measurable drop-off in the number of big IPOs.
I guess I'll take the other side of that and say that I don't think there's going to be any arbitrary date when suddenly there's a drop-off in IPOs. I think as long as this economy stays strong, as long as political news flow stays strong, then I think that we're going to see a continuation of a lot more great IPOs. I'm hopeful that we see Airbnb get out, Palantir, WeWork, Peloton is one of my favorites. Another one, which I really like, is Robinhood. So I think we're going to see a huge amount of really great companies get out over the next year plus. And again, I would say we need to focus on the business models. So Robinhood is one of the strongest businesses we've ever seen. It has this great smile chart where the DAU over MAU is terrific, especially for fintech. When we invested in Snapchat, it had a 50% DAU to MAU. But that's messaging. When you look at fintech, we have never seen something like what Robinhood is seeing. The same for Peloton. It's such a terrific business model. You pay $2,000 for this bike, and then you're almost feeling guilty that you have to stay in the subscription after that. It's why they have over a 95% retention rate.
Do they make money on the bikes, by the way?
They just make money on the bikes. Okay.
It's a great bike.
Build them to be pretty break even, but they just make a little on it. It's all the profits made on the subscription. So I'm bullish. Makes sense.
I have an apartment in San Francisco, so I can't fit anything in there, let alone a stationary bike. But it's a nice thing to think about someday. Your prediction, Nicole, had a pretty big caveat, which was as long as this economy stays going. And how long can that realistically happen for? We've been in what's the longest bull market in maybe recorded modern history. How do you, even as venture capitalists or as an exchange, model for that?
I appreciate the optimistic view. I think everyone in this room by nature, if you're not an optimist, you should leave this room. And I very much want want that to continue. When I think about next year, even just what's happened more recently today around trade, this is a big deal, and unwinding what's going on is more complicated. The truth lies several layers below the headlines, and we've done work on talked to former U.S. trade officials, and they warn us that there's some pretty significant damage that's being done. By the way, I'm not a trade expert, but I do see that as something that could slow things down for next year.
For me, I always like to think about the fact that history doesn't repeat itself, but it rhymes. And so just because other bull markets have been a certain way doesn't mean this bull market is going to be the same way. Yes, we're 10 years through a bull cycle, but actually the rate of growth during this bull cycle did not match the past one. So I personally think that we have some time to go. I do agree with exactly what Jack said around, I think that the market will just sort of pull back a little and be in a sort of no man's land over the presidential elections next year. But saving some big political issue, I'm hopeful that these good times have more to go.
Yeah, and I agree with that. And let me also clarify, I'm not a trade expert as well. But I think what we're seeing, especially with the recent job reports, it's the lowest employment rates, or excuse me, highest employment rates in a few decades. And that leads to higher consumer confidence. And so you've got just continued money in the system. And does that slow down? Yes. But we're also seeing those dollars not only go into consumer products, but also into the retail investment. And so does that stop at some point? Sure, certainly slows down. But I think in what we're seeing now, even though this run is getting long in the tooth, I do believe it continues again, through kind of into next year and beyond.
There's actually an interactive portion of this event. Hopefully, everyone, or for those of you who have downloaded the app for this event, and if you haven't, you should do that now. But we're gonna do a poll of you guys. We want to get your thoughts on this topic. We want you to answer, how will the tech IPO wave impact the broader technology sector? So if you go in the app, you should see that poll popping up now. The options are either it'll spur more enthusiasm for tech companies to go public, more interest in the tech field among recent graduates, private market investment will grow, or maybe after the initial IPO boom, more companies will prefer to stay private. So we're curious what you guys think about that, and we'll come back to it in a little bit. For now, I wanted to talk to you guys about this event. All of these IPOs that we're seeing represents a major economic event for California, and in particular, this part of the state. There have been estimates of thousands of new paper millionaires getting minted this year, and realtors girding for an even crazier housing market than we have now. What effects are we beginning to see now, and what might we expect to see in the future?
So we have an office in New York. We have an office in Minneapolis. We have a shared space out here, so I kind of go between the three. And what I've noticed is majority of our deal flow, called 600 companies last year, 70% of them came from here. What I've seen an increase just in the past year is the number of companies that will just have kind of a figure person here, and then the rest of the heavy lifting is done someplace else. I don't know how it's sustainable. The challenge with that comment, how the living here is sustainable, the challenge with that comment is you could have made that 5 and maybe even 10 years ago, and here things keep marching higher and higher. I just fundamentally believe that something's got to give at some point, and I think we're closer to that. And I think you're just going to see more companies do that exact approach by allowing other workforces outside of the Bay Area.
With regards to the housing market specifically, I think this plus 20-25% growth in housing prices it's really tough for people to get in. And then the press have really done us no favors because the press have been hyping up what happens when the lockups come off from all of these tech IPOs, then all of these executives will be buying prices. And so there's some scaremongering that's happening in the ecosystem. I think in reality, what's actually happened is just that people have been able to get secondary, right? So it's not like suddenly after the lockup comes off, you're going to see people all of a sudden be able to buy houses. There has been liquidity. People have been able to get secondary done. There are so many companies that email us saying, hey, do you want to buy out this executive secondary? So all of those have really started to increase over the last few years. And a lot of these large Series E's, Series F's are pure secondary. In fact, the crazy thing is that some of the Series B's that we're doing at Lightspeed are 50% secondary, and you have to do that because it's really a founder-friendly market at the moment. And so I personally believe that that press cycle is a little bit scaremongering because the secondary has already been happening and will continue.
Yeah, I agree with that. Just from at Nasdaq, we have our Nasdaq private market, which we can touch upon on probably a later point. But just at the volume of people that are, or companies, I should say, that are running secondaries, I feel a lot of this is baked into the local economy. So there is, again, cash in the market, and we're seeing a slowdown. And some of this is personal story because my wife is a realtor down in Menlo Park, so that was kind of our hedge here. But JJP Homes, if I can say that. But she's great. So, but what she had seen is, we had seen an influx over the last few years of foreign investors coming in and seemingly parking money, for lack of a better word, here, buying real estate, especially down in the cities and down the peninsula. And so that started to cease. We've seen some of a plateau on some of the housing prices around here. And I think, to your point, there's still supply and demand, but it's not a spike in demand like you would think from some of the headline stories. There's just different elements that go into each respective person's personal life and making that decision. And then again, how they some of them have the cash to go purchase the house, but others still need the loan.
So what are the companies that haven't had the liquidity event, the founders or the teams that haven't had it, how do they pay for things?
Hopefully they did it at their last company. Yeah, so I'm not disagreeing in the sense that we'll likely see a slowdown. And personally, do you hope this stops at some point? Can we get to a point where we price a lot of people out of the Bay Area? And we see that a lot, even, again, personal story of teachers at my children's school that I can't afford to live here on a teacher salary. We see firemen and policemen and women in that first responder world that are saying the same thing. They're having to travel an hour just to be at our local fire department. So I think there's a real broader economic issue there. But I think as it relates to the IPO market and what we're seeing.
I also wanted to pick up on something you said around international buying. I think that's a really interesting point because I'm British, as you can tell by the weird accent, and in England, London specifically, it just felt like the market was always going to keep going up. It was 25% to 30% every single year for 8 years, and mainly driven by the international buying. And then we had the big catalyst that was Brexit, and property prices are down 20, 30%, and there's just barely any transactions happening. And so that's the area that I do worry about, some kind of unforeseen catalyst that could cause, especially the international buying, to dry up.
Mm-hmm.
Let's go back to these poll results for a minute. I think the audience is sort of disagreeing with you, Jack and Nicole, that after this boom, more companies will choose to stay private, is the most popular answer, 42%. Number 2 is private market investment will grow. Looks like people are still voting. But number 3, more enthusiasm for tech companies to go public. Number 4, more interest in the tech field among recent graduates. I guess people aren't too optimistic about more talent coming in, which is a shame. But so a boom in the private markets. I think they agree with you that we won't be seeing this continued rush of IPOs.
Yeah, I think it's just the numbers. It's hard to look past what the pipeline's been.
So you just kind of see that there's this just pressure that was building up, and
yeah, I mean exactly.
Before maybe a recession or maybe a change in the guard in the White House and
exactly
uncertainties.
And there was obviously over the last 5 years a big change in terms of how these companies have been funded, the willingness of even public investors to have funded some of these, and there were just some bigger names that were benefiting from that. And so I think the pendulum will swing back probably 3 or 4 years from now, and we'll be back in a robust tech IPO market.
Going back to just the mechanics of an IPO, there's a lot of preparations involved in the road to an IPO, hiring banks, investor relations, roadshows, mock financial presentations. With the companies all of you have worked with, I'm wondering what was the biggest surprise for them or for you while prepping for an IPO? Jack, is there anything you see come up with the companies that you work with again and again that you're surprised by?
I think the surprise to my earlier point is how sophisticated a lot of them are now around the process. They're bringing advisors in earlier in the process, whether it be IPO readiness, whether they're engaged with lawyers or bankers, but as well as advisory firms. But they're starting to really get focused on this particular liquidity event earlier and we see a lot of companies that are having quarterly earnings or practicing closing their books 2 weeks after the quarter, just really almost operating as if they were public now. And I think that change has again led to a lot of their success in the aftermarket. I think also around the secondary liquidity programs that they run as a private company leading up to the IPO, they just don't have the pressure of having a great day one or a great first 180 days because they're not carrying the load of all their employees needing this to fund their lifestyles. I think they're able to clean up the cap table to the extent that they're confident going into the IPO that, again, this is really a capitalization event. They're going to leverage that for sure liquidity, but possibly investment in R&D for expansion around the globe, et cetera. So that's, I think that's been my surprise as of late.
Capitalization events aren't the only option. As Nicole mentioned earlier, there's the direct listings is this curiosity that has emerged in the last couple of years. I'm sure many people here are familiar with the differences between an IPO and a direct listing, but for those who aren't, direct listing lets shareholders sell their stock immediately on an exchange. There are no bank underwriters, no roadshow. One drawback is there's no fundraising for the company. But after 2 high-profile direct listings that we've seen, first with Spotify and then more recently with Slack, I'm wondering if maybe more companies that Lightspeed works with or that you talk to are treating this as a realistic option, if they're thinking more about going the direct listing route.
It's certainly a realistic option. I spent, before Lightspeed, I spent a decade at Morgan Stanley and across many different roles, but sort of everything from equity capital markets to equity research. And I just think it's such an important part of the IPO, the relationship that you have with those companies. We just meet the companies 2 years before they'd IPO. We do the pilot fishing meetings with them. We'd take them on this extensive roadshow. We'd make sure the book building was done in such a way that we had a really good high percentage of the book that was done by long onlys who would stay as long, stable shareholders of the business for many years. And so I think that's what's really lacking in these direct listings. For me, that's one of the reasons why Slack's down 20%. One of the reasons why Spotify traded up on the day, but then the 6 months afterwards also traded down. So I do think it's tough to think about the direct listings. Obviously has many benefits. that I think
essentially you just don't get the right investors involved.
sometimes you get the right investors involved, but there's less planning to make sure that you have the Fidelities, the T. Rowe Prices, the capital groups who are going to hold this for the next 5+ years. That's my worry.
Yeah, and I'll just add on to that. I think we were having a lot of conversations around this, especially after Slack's recent one in June. And I think it still comes down to you have to be of a certain size and a certain brand quality to make this successfully work. Because really what you need is on day one, you need volume. So you need Morgan Stanley, financial advisors in this case versus a banker. But your advisors will, circle up all the investors, all the shareholders, and try to bring them to market on day one so you have liquidity there, you have volume. And I think Slack did 45 million shares traded volume on day one, so it's successful in that regard. But to your point, you don't control that part of the process. So you don't know, one, who's going to show up. There's nothing contractually binding them to show up. So it's a lot of goodwill and good faith. And then two, who's on the other side of that buying the stock. So if you're not a well-known brand, not only to your institutional investors, but also your retail investors, but also to the analyst world. I mean, for Slack as a software name, there's a lot of coverage analysts that are going to pick that up. But then there's a lot that don't necessarily have to, and that's kind of the long tail of having coverage and continuing to grow your brand.
Gene, what do you think is the biggest incentive that drives companies to go public? Is it raising money? Is it allowing shareholders to cash out? Is it like the opportunity to have a marketing event to tell all these people about your company?
I think the biggest incentive is to give people a vehicle to, whether it's investors or employees out, an organized way to get out. And the reason why I say that is that capital is usually not a problem for these companies. There's so much money in the private side. So I think some companies, it's definitely, I guess I would say today, I think it's less of a brand building endeavor. 5-10 years ago it was more, but these companies have a lot of awareness. I think of Peloton, I don't know what the latest valuation is, but they have a brand that is bigger than their valuation, which is great for Peloton. But that's an example of a company maybe 10 years ago could have used an IPO as a brand building exercise, but doesn't need that today.
Now, it is a lot easier than it has been historically for people to sell their private stock, right? But is there still there's such a barrier that?
Yeah, I think it's the volume. We talk about an IPO, the volume of the amount of insiders that can sell, just that liquidity piece. I think having that in an organized fashion helps retain some of the value of a company. I think when you just have it on a marketplace and you start to, it's kind of like the idea of a more managed IPO, the benefits of a managed IPO. Mm-hmm. So, there's liquidity, but I think for broad scale liquidity, I think an IPO is the best way to do that.
Nicole, you were talking about the rise in secondaries at almost every stage of secondary sales as part of the fundraising. Is the stigma gone where, VCs and outsiders kind of expected, like, you stay invested with your company, like you eat ramen until you go public?
That definitely is still the case for the first few years, right? So I would say there's still many rounds, angel rounds, seed rounds, Series A rounds, before you get to a Series B where it's acceptable to then do those rounds of secondary. So I still think there's a lot of ramen noodles eating. The one thing I would say on your earlier question around the incentive for these CEOs to go public, sometimes they're not so quantitative. So for Katrina Lake, it was, hey, I want to ring the bell for Stitch Fix. I want to have my 2-year-old in my arms and say that we can do it all. For Evan Spiegel, he was highly incentivized, and we were early investors in Snapchat, but he was highly incentivized by Benchmark to the tune of hundreds of millions of dollars to IPO the business. And I think he would actually still tell you now he wishes he did not IPO the business. It has been a headache, and now Snapchat is back to the IPO price, but wow, he's been under a lot of pressure.
Well, thank you guys for coming out and for your attention, for your votes. Appreciate it.